Hello, and welcome to another episode of the Integrity365 Financial Insights Podcast. I'm Sophie Haslehurst, and I'm joined today by my colleague, Doug Sims, another independent financial advisor at Integrity. Today, we're going to discuss the new draft pensions death benefit rules that come into force in April 2027 and what inheritance tax planning strategies our clients could adopt. In this episode, we're going to discuss a little bit around the changes and sort of how they're actually going to work in reality, along with touching with what some of these solutions could be. In light of all these new rules and the drafted legislation being released, we wanted to unpack the change in the process, answer some pressing financial planning questions we're seeing from our clients, and discuss what this means for families and for us as financial planners. So, Doug, welcome and thank you for joining me. So, why is this such an important topic?
Yes, this is a really important topic, and speaking to a lot of my clients about it, is their biggest concern this year because, well, firstly, inheritance tax planning has always been a concern, and that concern's only getting bigger and bigger. What with the nil rate band and residential nil rate band currently frozen. And secondly, there's big announcements changes to pension death benefits in the October 2024 budget. So those changes which were announced have pulled in a lot more people to pay inheritance tax. So that's why it's so important to understand what these changes are and what financial impact it's going to have on clients.
And do you know what? It's something that I think everyone always thinks is quite an unfair tax, and it always seems to be quite controversial because I don't know if many of your clients say this, but a lot of my clients and even friends and family say, I've already paid tax on this money. Why should there be tax on it on my death?
Yeah, absolutely. It feels so harsh paying income tax or capital gains tax already on that earned income, only for it to be taxed when you pass it down to your children's upon death. Now, inheritance tax is as well, it's a tax that we pay by choice. You know, there is strategies that you can put in place by gifting to your children during their lifetime that will mitigate that. And we've all heard stories of how some of these ultra wealthy individuals avoid paying inheritance tax as well.
Definitely. So obviously, this is quite a big change coming in April 2027, but what are the current pension death benefit rules?
So the current pension death benefit rules, and when we talk about this, this is for unused pension funds.
Mm.
So typically they'll be in a SIP or a personal portfolio. So those funds that you don't use and spend during your retirement. So in the event of your death before the age of 75, they will pass down tax free to your beneficiaries, so free of income tax, free of inheritance tax. Post age 75, your beneficiaries, whoever that be, whether it be your spouse or your children, when they come to draw that pension value out, it's taxable at their highest marginal rate of income tax. So essentially, in the event of death before the age of 75, tax free. Post age 75, the beneficiaries will pay income tax.
So what's going to be the difference post April 2027?
So this is a big change, and effectively, in the event of your death, your pension assets are now going to be included inside your estate for inheritance tax purposes. So previously, they were outside of the estate. Moving forward, they'll be inside the estate. So similar to your property, your cash in the bank, your investments, which are all liable, potentially liable, shall I say, to inheritance tax. The pension's now going to be pulled into that.
That makes sense. But what does it actually mean in reality? So what do people who are inheriting that money or sort of receiving potentially that benefit in the end, or even if you're worried about how that's going to be passed on, how is it actually going to work in practice?
So in practice, it's going to be even more difficult even more administrationally heavy for those people. So, in the event of your death, shall we say, all your assets will fall inside your estate. Now, you've got a nil rate band of 325,000. Your spouse or civil partner, they will also have a nil rate band of 325,000. You may qualify for a residential nil rate band as well of 175,000 each if you are leaving a property, a UK property, to direct descendants. But that can also be tapered if you've got a very high value estate. So potentially up to £1 million in nil rate band. Once all your assets are put together, if that is above a £1 million, then your potential beneficiaries could be paying inheritance tax. So the personal representatives of the estate, whether that be your children typically, or you could even get professionals involved, because let's remember it is a very highly emotive time and it is quite a significant undertaking. If anyone that's done this for a family member or a loved one will know how much work goes in to managing an estate. So it will be their responsibility to get the value of all the assets, and now they'll have that added responsibility of getting the value of the pension schemes, tallying up the value of the estate to work out if any inheritance tax is paid. Once they've got to that stage, then they will have to now work out the amount of inheritance tax that is attributable to each pension scheme. Once they've got there, then they will have a couple of options. They could get the pension schemes to pay that inheritance tax liability, or they can pay it themselves. But we need to remember as well, if the individual that has passed away is above age 75, there's potential income tax liability on the beneficiaries there. If they get the pension to pay it directly, then there's no income tax liability. If they decide to pull that money out and then pay the inheritance tax liability, yes, you will suffer that income tax. You'll be able to reclaim it, but it's a bit of a messy process. So it's going to be difficult.
Definitely, and also I think what I'd say as well is, as you said, it's a really emotional time and it's really difficult. But if your main assets are a house and the pension and things like that, the liquidity of it is quite important, isn't it? Because people have to pay the inheritance tax within 6 months typically, unless you get a loan, where HMRC will charge you quite a high level of interest. So it's quite complicated making that sort of decision, as you said. Personally, if it's a difficult emotional time, it can. This is only going to add to people's burden, and that's why I think it's so important at this point to sort of come and speak to people like us, because we can support you with that process. I mean, hopefully we've been working with the family for a long time to give that guidance around areas like this and that support, but it can be so tricky, can't it?
Yeah, absolutely. It is going to be very, very tough, and that's why we always recommend people to stay in contact with their financial advisor, discuss this over regular reviews, to try their best to understand what is going to happen, and of course what they can do as well to help the personal representatives who will be looking after, well, the executors of the estate that will have to go through this administrational process. So, in terms of the importance of this change and how it's affecting people, Sophie, I know you've looked at a couple of stats and done a bit of research on how this is going to affect the UK public.
Definitely, because I think this is such a fundamental change. So, since we had pension freedoms in 2015, where people could suddenly leave their pension pots to whomever they wanted, it became a little bit of a no-brainer for a lot of our clients and friends and family to sort of keep the pension pot whole or as big as possible for as long as possible. So, I think some stats that I've read from various different sources. So, I think it's now 10,500 estates post April 27 are now going to be liable for inheritance tax purely due to pensions. Now that's quite a lot. Um, there's also going to be around 38,500 estates that are going to see an increase in their IHT, even if they were already near the thresholds, i.e., they might have been a little bit over. And to put some monetary figures on that, that means that 34,000 is what they're predicting from gov.uk, being the extra inheritance tax that estates are likely to be paying.
So just the extra average amount of IHT revenue on each estate that HMRC are going to get is over 30,000.
Yes, and I think what I would say, and I try and really drill this point home to clients, is say to them, if they've got maybe two or three children, I can sort of say to them now, especially when it comes to their pensions being part of their estate, it's almost as if they've updated their pension nominations to now have, an extra child in there, which is HMRC, because effectively HMRC is getting quite a large proportion of that pension pot if they're already likely to be there. It's also seeing a number of states being hugely impacted by that 2 million threshold for the residence nil rate band, because actually it's not unusual for people these days to have bought a house a few years ago and suddenly that house be worth, let's say, over 1 million. Then if you've got you've got some personal possessions, don't forget, because they can go up in value. You've got some, some cash, some investments, and your pension now, it's going to bring a lot more estates into that threshold of paying inheritance tax. And I think the projections are suggesting that by 2030, we're going to have around 9 to 10% of estates that are now going to face an inheritance tax bill, and just purely due to this pension inclusion, which is more than double what current proportions are.
So we're not just talking about the ultra wealthy anymore.
No, this is more everyday people, and it's worth bearing in mind. I've still got clients who are not going to benefit from the residence nil rate ban to the full extent because their house isn't worth 350,000. So it's sort of really important that that £1 million rule doesn't necessarily apply to everyone. And I think it's an area of a little bit of misconception, a bit like the 7 year rule with gifting and the tapering of the inheritance tax, which is sort of, I would suggest, one of the sort of most common misconceptions that people have. I think this is going to be a big bone of contention for people because it doesn't necessarily make sense unless you're familiar with it.
Yes, yeah, I come across that a lot speaking to individuals with the 7 year rule and how the tapering works. There is a lot of as you say, misconception out there and exactly how that works with clients. So it's important that individuals understand what they can do when it comes to their own inheritance tax planning and how important it is for them.
Yeah. And I think it's not all doom and gloom. There are still solutions, especially getting some support, over a year, sort of 18 months in advance as we are today, from that sort of rule change coming in. You've got people like us who are there to support, and we have still got options, haven't we?
Yes, yeah, and as I say, this is such an important topic that I'm speaking to a lot of clients about at this moment in time in terms of the strategies that they can adopt. But it's very difficult. I find with inheritance tax planning, there's not necessarily a clear-cut solution in comparison to other tax planning strategies that we have. The various strategies that we can use, it's all about what fits the individual the best. And firstly, we also need to think, is it actually a problem? Because you don't want to be gifting all your capital away and then not leaving yourself anything. What do you want to achieve in retirement? What are your ambitions? What are your goals? What holidays are on the bucket list? And that's really where our cash flow planning can come in with clients and really help them understand, right, how much money do you need now and for the rest of your life? And how much can you actually look to make inheritance tax planning strategies with? So, very interestingly, we were looking at the life expectancy earlier, and whilst it is 79 years for men and 83 for women, if you're already at 70, those figures change significantly. So, if you're a 70-year-old male, your average life expectancy is 86 with 1 in 10 chance of reaching 96. And for females, it's 88 with a 1 in 10 chance of of reaching 98. So it's very important to understand how much money you need for your lifetime. And once you've completed that stage, then it's a case of looking at the different strategies that we can adopt. And the first one that I like to encourage clients to do is spend it and enjoy it. That is the easiest and simplest way of doing inheritance tax planning, by getting money outside of your estate. But in all fairness, there is only so much individuals can do and can spend and want to spend, to be perfectly honest. Um, so there's other things that we can do with clients, whether that be gifting capital away. You have your annual allowance of £3,000 a year, which you can gift, and that'll be immediately outside of your estate for inheritance tax planning. Anything above that, that's where that 7 year rule that you discussed comes into play. And you can do that. You can give that directly to individuals, to your children, for example, or you can start to look at the trust options, which it comes across as a very scary word to clients, trusts, but I assure them it isn't. A trust is just an entity in itself that we can utilize. They're a lot more commonplace nowadays. And again, going back to average people being pulled into inheritance tax, trusts are used by everyday people now. They're not just for the ultra wealthy, the ultra elite.
Mm. And I think people can be worried about the complications that are involved, but ultimately we're here to help with a mindset shift, which I think a lot of people are going to have to take now with the pensions world and the changes that are coming in. But also that mindset of spending a bit more, as you say, when you save diligently through your working life and suddenly you're spending those savings, it's quite a daunting prospect. And I think the cash flow modeling that you described that we work with clients, and I know you do this on a regular basis, and when you meet with your clients at least annually, as do I, that whole mindset shift and that support action when it comes to going, you can afford to do this, and modeling it so that they feel confident, that forms a really important part of the offering that we give to clients, doesn't it?
It's amazing, the first 12, 24, 36 months of retirement with clients, getting their minds around, I'm no longer in an accumulation phase of my wealth planning. I'm in a decumulation phase. It's okay to see your money go down and spend it and enjoy it. It's what you've been working 40, 50 years for. It's okay. It's part of the plan. And that cash flow planning that we do really visualizes that and brings it to life for them.
No, it definitely does. So, we've covered quite a lot today, Doug, haven't we? So, just to sort of summarise that there are some huge inheritance tax changes coming in April 2027 around pensions. We're sort of pleased that we've got the draft legislation 18 months in advance because of the fact that it gives us the opportunity to start that planning process. And we've covered off how it works in reality and what those steps really look like, because that's important that you have an understanding of that, because it can help you to make decisions around your personal representatives, be that professional or family. And then sort of touched on a few solutions and some facts and figures to really give some basis to why we're talking about this today.
Yeah,
So
yeah,
hopefully that's been of use to everyone. And Doug, thank you so much for joining me today and for sort of talking about what I think is a really interesting and very sort of to the moment topic. And thank you all for listening. If you've got any questions about your financial plans in light of these changes and all the discussions around inheritance tax and possibly even the new budget coming up in October, November, please don't hesitate to get in touch with us at Integrity 365. And we've got further insights from our other independent financial advisors, and you can find more episodes of the Integrity 365 Financial Insights podcast on YouTube and Spotify.